VIX and VIX options and how to trade them. It's a pretty exciting market, we think, and we're having great success with it. And of course, it's been pretty active lately with all the volatility in the stock market. You can read this disclaimer for yourself, and typical disclaimers here, and our full disclaimers at the website. Basically, the summary is everything's your responsibility, and there's risk in all investing. Then we have a separate disclaimer regarding leveraged and inverse ETFs, which have their own issues and problems that you need to understand before you trade those issues. And then, of course, options trading, there's a U.S. government required disclaimer, and that's a standard disclaimer regarding option trading. So we're going to talk about VIX today, and a little overview of what it is, how it works, how you can trade it using futures, ETNs, or options. Then we talk about some trading strategies. Where is VIX now? What does VIX say about equities? And that's quite interesting because a lot of people view the VIX index as a predictor of what's going to happen to equity prices. It's known as the fear index, and so as VIX goes up, fear in the stock market is also thought to be going up. And then we're going to talk about how you can make money in both up and down markets using VIX. We use Ichimoku Cloud Trading, a proprietary version of that. We'll talk a little about that. And we're going to talk about trading VIX options and then today's trading opportunities in the markets. So what is VIX? You know, it's the Chicago Board Option Exchange Volatility Index. It shows the market's expectation of the 30-day volatility looking forward. This thing is updated minute by minute, and it tracks the S&P 500 options exchanges. First came out in 1993. There's a second one that came out in 2003. That's the one that's still in use today. It's commonly known as the fear index, and it's a widely watched and traded index. It's really become a new asset class. It's been hot lately, and we'll talk about some of the ETFs involved in that in the recent news. But as a trader, you can use this for directional trading, diversification, portfolio hedging, or volatility options trading. So here's looking back about 20 years. You can see the scale of VIX is 0 to 100. It tends to be mean reverting, so if there's a spike up, it'll tend to go back towards its average. If it's typically low, it'll mean revert back up towards its average. You see the long-term average is around 20 to 25. Recently, though, with the last several years of quantitative easing and zero interest rate policies, it's been around 15. So it's been a very low volatility period. Although, as we'll see in a few minutes, there's just been this spike recently with that big sell-off in the market, the last 2 weeks, a big spike in VIX, and we'll see how that typically behaves and how we can trade that. So all kinds of different ways to trade the VIX. If you're a futures trader, you can trade it on the CBO Futures Exchange just like any other futures product. If you're an options trader, you can trade it in any kind of options approved securities account, risk management, and speculative tools. You can do both. You can also trade VIX options within an IRA with certain brokerages, so that's quite an advantage to us as retail traders. And then there are VIX ETNs. We can go long or short, and we can also do options on the ETN. So there are many different ways to use these vehicles. You need to know what you're doing, of course, because they move fast and they act like leveraged products, but they do provide terrific opportunities. So the most popular ETNs are the VXX. That kind of is designed to track the short-term futures of the VIX index. And then an inverse one is the SVXY. Those are the two most popular ones in terms of volume. And then these others are also well known, especially the 2X, the leverage ones, the TVIX, and then there's a UVXY. Those tend to be very popular because now you're putting leverage on top of volatility, so that can be a fast-moving trade. So we got the major providers, iPath, ProShares, Velocity Shares, and you can go to their websites and learn all about these. I really recommend you do that because these are sophisticated products, and you need to know what you're doing and how they actually are priced and how they work. So here's VIX going back to 2008. You can see how this thing spiked up during the big financial crisis there at the end of 2008. It went almost to 100. Remember, this top of the scale is 100. It went to 90. And then as the Fed stepped in, it steadily declined back down into the 20s. And then today it's in the 16s, so we'll talk about that. And so you can see this over the long term here, there's some really good short-term trading opportunities in both up and down markets. So there's plenty of activity here and plenty of opportunity. We talked about it being the fear index, how it compares to the S&P 500. So VIX is the candlestick chart here, and the S&P is the gray line. So you can see as VIX declines, the S&P will go up. As VIX spikes, the S&P goes down. So they move inversely to each other. So where's VIX now? Let's talk about that. You know, we had that recent spike with that short-term sell-off. You can see how in February there, VIX spiked up from around 12 up to in the 20s, 25s. But now it's coming back down. You can see how it was a quick spike and now is returning back towards its most recent median around 15. And that is indicative of the decline in volatility. The Fed's starting to say they're going to be more dovish on interest rates. And so you can see the short-term pop there to go up. But typically, you do better trading VIX as a seller and knowing that it's going to be a short amount of spiking when it does go up. All right. So what's VIX saying about equities? Same thing. You can see where VIX had that big spike. Equities took the big drop there back in the early part of late January, early February, and now it's mean reverting. Equities are starting to attempt a recovery. And of course, we're in a very overbought market. You know, depending who you read, this is the second most overvalued market in history, with 2000 being the highest. Some analysts even say that it's the most overvalued market in history, even more than 2000 or 1929. But nevertheless, VIX can give you an idea of where the stock market is going next. So as far as trading strategies go, there are a couple of really good ones for us to take a look at. We can do long and short VIX ETN. So SVXY is an inverse VIX ETN. And so as VIX goes down, this goes up. And so you're selling volatility and not buying it. And then VXX is the lower probability trade, but it's really good for short bouts of volatility. So you have you can go long and short the index using these ETNs, and you can use these in any kind of a retail trading account or in your IRA. So we're going to talk about several different strategies you can take a look at and think about, and then we're going to talk about what we're actually doing specifically at tradinggods.net. So one is using RSI, and that's a pretty well-known strategy. When RSI is high, up around 70, overbought, then typically there's going to be a decline in whatever that underlying index is. And when it's down around 30, there'll typically be a rise. And you can see how that works here, and VIX trades that way just like most any other product does. So it's at least one thing to take a look at and consider as, you know, part of your toolbox or confirmation of other trading strategies. Then there's a 2-period RSI. This is a much faster moving idea. You do RSI and then put 2 on your chart instead of a typical 14. And you can see again how when it's overbought, then the next move tends to be down, oversold, the next move tends to be up. This is much faster. You got to keep a closer eye on this, trade it more actively, but it also gives you some real opportunities for some short-term moves. Point and figure charting isn't used very much anymore. It was Charles Dow actually used this himself. But it's a whole school of charting, and it works in VIX trading as well. It takes out the time factor, and when you're in a column of X's or above the blue lines there, the market is bullish. When you're in a column of lows or below the red lines, the market is bearish. So it gives you like a very clean look at what the trends are of whatever index you're looking at. And these work for everything too, not just VIX. It can work for any kind of stock you want to track or anything, any ETF. And of course, MACD is widely known as a trading strategy, and it works here as well. You know, you can use that in a combination with moving averages to get an idea of where the markets are going. Of course, the disadvantage of all of these things is they tend to be lagging indicators, trend following, tends to show you what has been happening less than what's going to happen. And so they did have some inherent weaknesses, even though they are quite popular. So if you're using point and figure charting, that gives you a little bit of an edge in terms of what's going to happen next. This is one of the things we teach in our courses. Gives you entry points, exit points. And really it's a chart of supply and demand. So it'll show you when you're in a column of X's and the column of X's moving up, demand is in control. And when you're in a column of O's and the O's are moving down, then supply is in control. So it's pretty easy to use this to set and manage a trade. And it gives you a real clear look at the market without all the noise and the time factors included. So this is one of the things we teach, and it's, people find it quite accurate. It's kind of arcane. Not too many people use this anymore, but it does have some significant trading advantages. It allows you to determine your entry point, your stop loss point. You can confirm it with a momentum chart, and then you can just manage the trade, which of course is the most important thing. All these things you hear about and learn about, there's very little discussion about risk management and how to manage the trade, and that's probably the most important thing at all, so you don't blow yourself up and take too much risk, and then how to control risk, because as humans, we all want to, the typical mistake that everybody makes is you hang on to a trade way past where you should have, and you don't want to take the loss. You've heard that, oh, it's not a loss until you close the trade. Well, that isn't true. Professional traders look at it the opposite way. It's not a gain until you close the trade. And so this allows you, these type of structures here on the point and figure chart allow you to see exactly where not the trends, but where the mood of the market changes and what's in control of supply or demand. And then now really our active thing is Ichimoku Cloud. I didn't invent this. I wish I had. This guy was a genius. As a Japanese individual. I think he was actually a journalist. It's been around for a long time. And it looks kind of complicated, but it's really a very sophisticated predictive moving average system. And we'll talk about each of these lines just briefly, but that green line there is known as the lagging line. That's a longer-term moving average. And then the red line is sort of a fast-term moving average. The blue line's a little slower. And then that cloud is a combination of those averaged out. And it shows you, so you can see here really clearly, when price moves above the cloud and above these lines, you're in a solid uptrend. And then when it moves below those lines or below the cloud, you're in a solid downtrend. And it actually has a predictive feature, which we can look at to the far right there. It'll show you what's going to happen next. I can see back here in September 16, it was an uptrend, and then it turned darker blue, and then back up. So it had a little downtrend there, and then back up. It'll actually look ahead 30 days and tell you what it anticipates coming next. So without getting too detailed on what each of these lines mean, basically a red's a fast line, and you can adjust these settings. It's generally a 20-day moving average, and then the cloud gives you some support and resistance. And then the green line, the lagging line, we use as a confirmation of the trend. So you have a lot of ways to take risk out here and to know that whichever is happening, the trend in whichever direction can be confirmed with that green line, which is a 26-day lagging indicator. So there are a lot of different ways to trade this thing. You can do it by the minute, you can do hours, you can days, and whichever your trading style is, and it works really in any time frame and in any vehicle. It can be ETN, stocks, whatever it is you're trading. So the basic rule is when the price is above the cloud, you're in a bull market. When it's below the cloud, you're in a bear market or a downtrend. And then the blue and red line can be buy and entry points. People use those as moving average crossovers, or when the price drops below one of those lines as sell signals. So it's a very sophisticated trading tool. We use this all the time. We have a proprietary way we do this. And it's just a very cool system. Like I said, I wish I'd invented it, but I didn't. It's used a lot in the forex markets, and I haven't seen it around too much in ETFs or stocks, but it certainly is effective in those markets as well. You can use it for options as well, you know, directional trading in options. If you're an uptrend, you can buy options if you want to take that risk. Or if it's an uptrend, let's say in this chart, we could sell put options and collect the premium, you know, be the house, get credit for the trades. So many different ways to use, very flexible tool, and we talk about this a lot in all of our courses. So as far as best VIX ETNs go, right now, if you want to be short volatility, the SVXY is the ProShares Inverse ETF. This is a really interesting chart. Take a close look at it. Back in March, between March and just a couple of weeks ago, this thing gained over 100%. And then with that big sell-off, it dropped like 90%. You see that big drop? So there was another inverse one, very famous, XIV. That thing actually went out of business. It dropped over 90%, had what they call a termination event. And I think people lost, I don't know what the total losses there was, something, you know, way over $1 billion, I think. But if you trade this, so you can't buy and hold these things, obviously, but if you trade them, there's significant opportunity for gain, and you can get out before, you know, typically the Ichimoku cloud will get you out before a big sell-off like that one just occurred. And now if you look at this is going to be an amazing buying opportunity, not if, but when the markets recover, because this thing moves significantly faster than the S&P 500. People are really attracted to it, and it's going to have some terrific upside potential here sometime, and that'll be a matter of you know, just watching the cloud and seeing when that happens. So then we've got VXX, which is the long. So VIX, when the index spikes, VXX will go up, and you can see how that just spiked up here in the last days of early February here. High volume, you know, highly used ETF, trades 16, 20 million shares a day. But again, it's not really, you have to be very nimble to use this thing, and because the spikes are short-lived, they can be dramatic but short-lived. But overall, it's really better for shorting or for doing credit spreads on options on both sides of this, depending what your directional bias is. So people who buy this and hold it will lose all their money. The prospectus actually says that, the way this thing is priced. But if you know what you're doing, there's some tremendous opportunities here, especially on the short side of VXX. So to talk about options a little bit, they were started in 2006, and you can get options on VXX, SVXY, or TVIX. So that's like any other option trade, but with a couple of really built-in advantages. They're highly liquid. They're easy to trade. You can trade them within an IRA with certain brokerage accounts. And because of the volatility, they tend to have high premiums, and they also decay rapidly. And so as an option seller, you can make money, and if you're on the right side of these trades as a buyer, you can certainly make money. Of course, the key to any option trading is, and the gentleman just before me addressed this, manage the risk, manage the trade. You need to learn how to reset it. If you're selling, how to roll up or down or out. You can buy puts or calls. You have to have a known amount of risk. But lots of benefits here. But this is like becoming a concert pianist. You're not going to play at Carnegie Hall on the first day you try this, and that's why it's important to study this like any other subject. But if you do get good at this, these are liquid markets. They're easy to manage. We take trades that have a high probability of success, 80% or better typically. And they're short holding periods and can generate monthly income. So our main focus is VXX, and we do some SPY ETF option trading, but mostly the VXX. Highly liquid. They benefit from the time decay. And we do directional long trades, and also these vertical calls and spreads, the credit spreads, where you keep the credit. You become the house, and then as the spreads decay, you collect the premium. So again, we have a known amount of risk on those spreads. We always have trades in the 80-95% probability of success. There are two ways to do this. You can do short holding periods, which has its advantages because most of the time decay comes in the last 30 days. Or you can do long periods where you sell a spread way out and just let it decay slowly, or a combination. we typically will do, it just doesn't trade a lot. We typically will do just one trade a month, and we're going to do one set up tomorrow for Monday. And then every month we do that, we'll close one and open one. So it doesn't trade a lot. You don't have to live at your computer, and it's not a full-time job by any means. And you don't have to be right about the market direction when you do this kind of option trading. So that's a plus, we think. Lots of benefits, of course. You've heard all these things before, you know, the financial lifestyle goals, monthly income, and then the ETF trading goals. Those vary. You can stay in those for quite some time or be in and out quickly. And those, of course, to grow your asset base. So we have new trades starting all the time. We do options and ETF trading as well. And the way we do this is there's a members page that you can go to and see what's going on. You also get a VIX Trader alert email. So you get the trades as they happen, and we trade real money with these things, exact entry points, exit points. And then we do long, short, as we talked about, and then the spreads themselves. We're also about to open up a let's see how I describe this on the weekend, a course, I guess. You know, we'll be having a live teacher log in, and you can, it won't be one-on-one, but it will be a trading opportunity, a trading course to actually learn how to do this for real, and where it really has some value, you know, because if it doesn't have value to you, you know, we really don't want your money. And so that's the key thing to this, that these things do have value for you. So right now we have a flag system for equities, you know, green, yellow, red. Right now we're in the yellow flag mode based on what we're seeing the VIX index doing. And for S&P, for the SPY, we particularly watch. So as I mentioned before, markets are vastly overbought. So, but offsetting that is they're seasonally positive right now. You know, this is quote, the best 6 months of the year until May. You know, you all heard that, the sell in May and you go away idea. And that has a historical basis to it that's real. And then, but we are near all-time highs. And of course, the recent volatility is spooking people. And that is based largely on what the Fed does. And I think we have to really keep track of what the Fed is doing, because they've been driving this market now for a long, long time. And interest rate, of course, affects stock prices directly. And so these tightening cycles typically end in recessions. I mean, I think I read 19 out of 22 tightening cycles ended in recessions. So it appears that we're at the end of this easy money cycle, and that we're going to be heading towards a tightening cycle. And should that happen, now we're going to see a change in market climate. We're going to see more volatility and perhaps another bear market, who knows, but certainly that would be you know, a likely possibility. So we're watching the interest rates. Opposite that is, of course, the Trump effect is still in play, and the tax cuts. I mean, markets love free money, and certainly the tax cuts are going to help earnings and help corporations, and whether it helps the country or not, you can make your own decisions, but it's certainly bullish for the stock market. So there's a real tug of war going on here. Some people say, no, we're doomed. It's the most low-value market in history, and it's going to revert, and we're going to have a sell-off back to, you know, 12,000 on the Dow. Other people say this is going to go on forever because tax cuts and good earnings. So it doesn't really matter to me, because we're just going to follow the Ichimoku cloud and then see what happens and do that. But it's very difficult to argue with history, and these markets tend to be mean reverting. You know, we all know that. And as people say, it's not the most overbought market in history, one of the most overbought. And again, earnings are the mother's milk of stocks. So take your pick on the argument, but as I mentioned, it doesn't really matter, because we're just going to do what we do. And that's what you have to do, is turn out all the noise. The worst thing you can do probably is listen to CNBC or any of the media outlets. I'm not picking on CNBC, but any media outlet the noise there just confuses people, and it's best if you just focus on what you're doing and stick to that discipline, which is the hardest part of this, is that internal discipline. All right. So for trade-thirsty people, we've worked with Jeanette and this group before, and they're great people. We have a special offer. It's a $9 mini trading course. You can get it at that link there. And then if you decide to continue, there's a one-time buy-in. It's a $975 for the TradeThirsty members. And that's a one-time fee, so it's not monthly, it's not recurring. So that's a great value. I mean, you can spend $900 or $1,000 a year easily. But in the $9 mini course, you get several modules of videos, how to trade the index, what it is, the best ETNs, options trading, and then 2 weeks access to the trade alerts. You can see how the whole thing looks. And we'll be doing some new trading tomorrow, and the links are clearly there. So that's it, I think. Jeanette, are you there? Hello, Jeanette. So I'm looking at lots of questions here and trying to figure out.
I'm here. What happened? I had my headset down. I heard you say my name.
Okay. Well, I'm just kind of wrapping up here, so I'm trying to read these questions. I can't make the panel big, the questions panel. I don't know how we do that.
Okay, hang on. Let me help you. Okay. Do you see how you do you know how to pop out the control panel, the questions part of it? If you see,
no, I don't see.
Do you see on the list where it says audio, dashboard, polls, handouts?
I see the handout, okay, and then
you see the word questions. You might have already popped it out.
Yeah, I see the handout. I see the pencil.
You don't
I see the question panel. I see the question panel. That's kind of real small,
Yeah. All right. Let me just. I'll just ask the questions for you. How about that?
Or you can take back control, maybe, and show them.
Well, I mean, we don't show them. There's no way to show them. You can't drag it like that. But I can read you what they're asking. Let me go back for a minute. All right. Let's see. I'm trying to think of when you started. I'll start from the bottom up. Okay. Oh, somebody's asking for the link. What's the link? 3 people.
Right.
What's the link? Tell me the link. Put it back up, and I'll type
I'll
it in
put the link
for you.
back up there just a minute. Of course, it's the last one at the bottom, so we'll get down there fast. Oh, there we go. Okay, so there it is.
All right, TradeThirsty.com/Sam. Let's see.
Yeah, that just goes to an order form for this $9 thing. It's it'll do credit cards or standard stuff there. So.
All right.
And that puts you on the. We have 2 daily newsletters. One stock market recap and one VIX recap, and then we have a weekend one, a weekend webinar, and of course the trade alert. So this $9 thing gets you into all those.
Okay. All right. Someone say, explain the XIV blow up February 6th, 2018, please. Caused a market.
Yeah, well, that was really dramatic. I mean, I knew that was possible. If you read the prospectus ahead of time, it said that I think it was 80. If that lost 80% of its value, then it was called a termination event. They could close that ETF. So, which is really, I didn't even know that was possible until I read that in that prospectus. I have a feeling that many of the people who were trading XIV or just buying and holding it didn't know that either, because if you knew that, you certainly wouldn't be buying and holding it. You'd have a trailing stop or some kind of exit plan. So anyway, what happened, excuse me, so what happened was, if you look at that chart of XIV, it was a dramatic uptrend, I mean, for years with a couple of big sell-offs, but nothing like the one that happened in February. So it kept going up and up and up, and it became a really overcrowded trade. And so there are lots of people in it, lots of money in it. And then when there was that big volatility spike in February on the stock market, of course, VIX went way up. So then XIV had to cover their positions in the futures market. So that entire move, that 90% drop, happened after hours as XIV was covering those inverse positions. And so if you were in XIV on whatever date that was in February, you were stuck. There was no way to get out, and people lost. I read a couple of accounts. People had articles. People had $3 or $4 million, and they turned 50,000 to 3 or 4 million, and overnight it got vaporized. Literally, they woke up with basically zero or 10 or 20% of whatever they had previously. So the moral of that story is these are sophisticated products. You have to know what you're doing, and I just had the hunch that a lot of people didn't because there was a tremendous wipe out there. But the ETF did exactly what it said it was going to do. It tracked the inverse. It went inverse the VIX. It had that big spike. It had to cover its positions just like any kind of a short position, and so it got wiped out. Interestingly, the SVXY, which we just talked about on the chart there by pushers, had the same kind of decline but stayed in business. So I don't know exactly why. It must have been they're set up differently, or they have some different rules, but they're still around. So as I mentioned in that one chart there, I just have a feeling the way greed, fear took over that day in a big way, but greed again is going to take over sometime here. And when that thing is now trading around 12 or something, it used to be at 120. That's going to be like the buying opportunity of the century one of these days, because people are going to come back. You know how that is. People forget, and there are new opportunities. And there's always, there are two motivators. I've always heard fear and greed, but there's a third one, and that's fear of being left behind. And those things are highly public and high visibility. And when that starts to move again, I think you're going to see that same kind of sort of freight train effect taking place.
Okay. This question is: does the VIX or the S&P lead or lag the other?
Well, that's always an argument. Depends who you are. Some people say the VIX leads. Some people say it's reactive. If you look at those charts, the VIX will tend to, in my view, tends to lead a little bit because VIX options traders and VIX traders are sophisticated institutions, hedge funds, and they have enough capital and enough the logarithms that they will tend to lead the markets in my view. So I would say there's a slight predictive edge for the VIX index.
Okay. Does the VXX decay rapidly during VIX roll to the next quarter during rollover?
Yeah, the VXX, is a really interesting ETF. Read it's actually an ETN, but read the prospectus, and it'll tell you if you buy and hold that thing, it'll go to zero. It's designed to do that. It's like a leveraged ETF. It'll reprice every day. And with the drag, like you just mentioned, the contango, the roll rate, on average, if nothing else is happening, that ETF will lose about 4% a month. And it's been had reverse splits. I don't know how many reverse splits it has. It's going to have another one. Maybe not now because we just had this big spike, but it was getting down, into single digits, and it keeps doing these reverse splits. But it's really popular. People buy it, I think, for a couple of reasons. Institutions and hedge funds investors buy it as a hedge, so they don't care if they're losing a little on it, and they buy options on it, same thing as a hedge to their underlying positions. And then I think speculators, it's like buying a cheap out-of-the-money option. You're hoping for that big pop and making the big gain, but the odds are definitely against you. And if you look at a long-term chart of VXX, it's just a steady decline towards zero until they do those reverse splits on it.
Okay, all right. Can you explain again, Robert wants to know, can you explain again what you meant by one of the volatility symbols going down to zero? If that is true, why don't we just sell an unlimited number of bear call spreads on it?
That's a good strategy, and we do that a lot. We sell bear call spreads, but again, there will be those spikes in there that can just take you out. You know how spreads, if they go in the money against you, all of a sudden it becomes a really asymmetrical trade. You can get smacked if you let them ride in the money. So you cannot hold those things, of course, and you have to be actively managing them to protect your risk there. But you could make an argument for you could sell VIX short, VXX short, and it's just the way it's built. It's completely in your favor as the short seller.
Okay. Jahan is saying, I bought the $9 program, don't see the videos or lessons. Thank you, just saying thank you for your purchase. Do they get an email with access on how to get in there? Is that how it works, Sam?
Yeah, you get an email that says it has a link to the to that course, and then it's a password protected. There's a password, and then it lets you in. It's about 8 videos, and then you're on the list as well. So should happen automatically.
Okay.
I tested it this morning. It works. I hope if it doesn't work, you can write. There's a couple ways to contact us on the website, and you can write dan@tradinggods.net, and then if it doesn't work for you, then we can. And you get that. I think that you get that same link in the purchase confirmation, and we'll get it set up for you, right? If it doesn't work, but it should be working. We tested it this morning.
All right. How many trades do you make per week on average, and what's your average holding time?
Well, like I said, it doesn't trade. Our shortest holding time would be around 30 days, and we can go out as long as, say, 90 days. And we don't trade a lot, like maybe, like I said, maybe once a month, maybe twice a month, one in, one out. So it's not something that you have to do every day or stick with. If you want lots of action and a fast-moving thing that you're doing all the time, this isn't for you. This is I wouldn't say long-term, but say 30 to 90 days. It's a little bit like watching paint dry, but I think George Soros said once, good investing should be boring. And so if you want action and lots of velocity, this isn't the place to be. But if you want to, let's say, be the house, where the markets are really, I won't say rigged, but certainly the structures of the VXX is certainly in place in the, as we just talked about, in the seller's favor. And so to answer your question directly, 30 to 90 days and about 1 trade a month.
Okay. Do you trade VIX futures?
No, I don't. That's a whole separate thing. You have to have a futures account and all that. This would work on the VIX futures. The Ishimoku Cloud would work on the futures. But this is designed for a retail trader like I am, and probably most of us are. You can use it in a regular brokerage account, and you can use it also in an IRA account, which has some real advantages, of course, everybody knows tax-wise. And you can trade options depending on which brokerage you're with in an IRA. So this is designed for a retail trader.
Okay. Would you find that it's better to buy puts on VXX or sell call credit spreads?
I'm sorry, you kind of blurred out there, Jim. I'm sorry.
Okay. It's the question from Ellis is, do you find that it's better to buy puts on VXX or sell call credit spreads?
Generally selling call credit spreads, because you don't have to worry about the timing if you're right or not. Anytime you buy an option, you have to be right about direction and timing. If you were going to buy a VXX put, I would go pretty much as Dean in that previous discussion mentioned, go way out, deep in the money and way out in time to give yourself the best advantage. And you can certainly do that. We don't do that very much.
All right, and the link is right there on the screen, Bob. It's TradeThirsty.com/Sam, and I'll post it one more time. Okay, before we go, because we can go ahead and move on, what is your last question? What is your recommended position size? It's a tough question, but I'm sure.
Yeah, well, that depends on your account size. You know, I think that is a very complex question. It's your time horizon, your risk tolerance, and how much money you have. Because the idea is you don't want to blow yourself up. You know, so these are pretty high percentage trades. So let's say you could risk 5% of your account per trade. You know, and then these credit spreads, you have a known amount of risk. So you can figure out exactly what that is. You know.
Okay, all right. I think I've covered. Y'all, if we missed your question, you can send it to me at help@TradeThirsty, or any comments or questions about today, and we'll get it over to Sam. Sam, is a lifetime membership, is $975 a lifetime membership? If not, how does the membership work?
It is a lifetime membership, so it's one-time fee, and that's it. So as long as we're in business, you have access to everything, and that's it. The $9 one is good for 2 weeks, and then it takes you off automatically.
All right, Sam, that's a wrap. I'd like to thank you for joining us today, and we'll keep posting your link for you, and also make sure that we get the recording out to everybody that was here with us today. So I'm going to go ahead and remove you as the presenter and take back presenter status on my side. And if you just be careful, if you decide to leave, that you don't close the room out for everybody. I would certainly appreciate that.
I'll close it out once you take it back. Thanks, Jeanette. Always great talking to you. Thanks, everybody, for joining. TradeThirsty is a terrific group, and there's lots of value here, and so I'm glad you're all here. And thank you, Jeanette. Great talking with you.
All right, brother. Talk to you soon.
Bye now.